Welcome to The Explainer. Today, we're diving into a paradox that trips up even the smartest people in business. How can a company that's making a ton of profit still go bankrupt? It sounds completely backward, I know, but cracking this puzzle shows you what really keeps a business alive.
So, seriously, how does this happen? You see a company posting record earnings, everyone's talking about their hot new products, and the income statement looks absolutely fantastic. But behind the scenes, they could be just weeks away from not being able to make payroll. It seems completely counterintuitive, but it's a story that plays out all the time.
And this isn't some rare freak occurrence. A study by US Bank found that a staggering 82% of small businesses that fail don't fail because they weren't profitable. They fail because of poor cash flow management. Let that sink in. More than 4 out of every 5 failures come down to cash, not profit. So what's the deal? Well, it all boils down to this fundamental difference between profit and cash. Profit, you see, is basically an accounting story. It gets recorded the second you make a sale, even if you won't see that money for 90 days. But cash flow, that's the cold, hard reality. It's the actual money coming into and going out of your bank account. You could say profit is a promise, but cash is the fuel that actually keeps the engine running. And this quote right here just nails it. You can't pay your rent, your suppliers, or your employees with a number on a spreadsheet. You need actual cash. Without it, even the most profitable business is going to grind to a halt. So, okay, let's get into the metrics that show us the real story behind a company's health. All right, first things first. The most immediate question you have to ask about any business is, can it survive the next few months? This all comes down to a concept called liquidity. It's the ultimate test of whether a company has enough cash ready to go to handle its short-term bills. The number one metric for this is operating cash flow, or OCF. This is the cash a company generates from what it actually does, selling its products or services. It cuts through all the noise from things like investments or loans. For a mature company, you look at its operating cash flow ratio. If that's over 1.0, it means they're generating enough cash to cover their immediate debts. For a startup, you might look at the flip side. Its cash burn rate, which tells you exactly how fast it's using up its cash reserves. So, what does a healthy operating cash flow really tell you? It tells you that the business can pay for all its day-to-day stuff, payroll, rent, inventory, with the money it's actually earning. It's the clearest sign you can get that a company is self-sustaining and isn't just surviving on borrowed money. Okay, so moving beyond just surviving day-to-day, a great company is also super efficient. It's not just about making cash, it's about how quickly it can turn its inventory and sales into actual cash in the bank. And that brings us to the cash cycle. We measure this with something called the cash conversion cycle, or CCC. Think of it like a stopwatch that tracks how long a dollar is tied up in the business. You figure it out by adding the time inventory sits on the shelf to the time it takes customers to pay you. And then, this is the magic part, subtracting the amount of time your suppliers give you to pay them. And in this game, the shorter the cycle, the better. But here's where it gets really interesting. What if you could master this so well that you actually get paid by your customers before you have to pay your own bills? That, my friends, is the holy grail of cash management, a negative cash conversion cycle. And the masters of this universe? Companies like Walmart and Amazon. It's their secret weapon. They use their enormous size to demand long payment terms from suppliers, maybe 90 days. But when you buy something, they take your cash instantly. So for months, they're essentially using their suppliers' money interest-free to run their own business. It is an absolutely incredible advantage. Okay, so a company can survive and it can operate efficiently. That's great. But what about the future? How does it grow, innovate, and take on big new projects? For that, it needs more than just enough cash to get by. It needs a surplus. And this brings us to what might be the most important metric of all, free cash flow, or FCF. The math is pretty simple. You take that operating cash flow we talked about and subtract capital expenditures. That's the money they have to spend on essential stuff like buildings and equipment. Whatever is left over is the true discretionary cash the company can play with. This free cash flow is literally the fuel for the future. It's the money a company uses to pay down debt, develop new products, buy other companies, or give back to its shareholders. A business with a lot of positive FCF is a business that's in charge of its own destiny. So what happens when this goes wrong? Well, the stories of Toys R Us and WeWork are just perfect cautionary tales. Toys R Us was profitable for a long time, but it was drowning in debt. All its cash went to paying interest, leaving nothing to invest in things like e-commerce. And WeWork? They chased massive growth, but it was all funded by investor optimism, not cash from their actual operations. The second that outside money dried up, the whole thing fell apart. So, how can you actually use all this? Let's put it together into a quick financial checkup that you can use to look past the flashy headlines and see what's really going on inside any company. The first thing to always remember is that profit can be, well, let's just say it can be manipulated. Accountants have all sorts of non-cash expenses, like depreciation, that can make profit look smaller or bigger. But cash flow? It's much harder to fudge. The cash flow statement gives you a straightforward report of the actual money that's available. So you can apply this really simple 3-step toolkit. First, can it survive? Check its operating cash flow. Second, is it efficient? Analyze that cash conversion cycle. And third, can it actually grow? For that, you look at its free cash flow. Survival, efficiency, and growth. So the next time you see a headline screaming about a company's record profits, you'll know to pause and ask the much more important question. That's great, but are they actually generating any cash? Because now you know that is the real story of business survival.